So you've probably heard it by now. Elon Musk says Tesla isn't just a car company anymore, it's an AI and robotics company. And just like that, the whole story shifted. It's no longer about how many cars they sell, it's all about autonomous miles. But we need to look past the hype and really unpack the business model here.
Because at the end of the day, it all boils down to this one question. If the math on a $30,000 cybercab doesn't work, then that whole trillion-dollar valuation, well, it's pretty much built on sand. So today, we're not analyzing a car. We're analyzing a brand new type of financial asset.
And believe me, the stakes could not be higher. Just look at Wall Street right now. They are completely split. You've got some analysts saying the stock is worth $119 and others saying $600. I mean, that's a five-fold difference for a massive S&P 500 company. That's almost unheard of. This isn't just a small disagreement. It's a huge fight over what the future of transportation and maybe even wealth is going to look like.
Okay, so let's get into it. Here's the plan. We're going to start with the dream, the utopian vision of this thing. Then we're going to bring it all crashing down to earth with a serious reality check. And finally, we'll put the pieces back together to understand what this new world of autonomous assets really means for all of us.
All right, first up, the bull case, the dream. And you got to understand, this isn't about just building a new car. It's about creating a purpose-built, cash-generating machine from the ground up.
So how do you even get the price low enough to make the numbers work? Well, it starts with a totally new way of building it. See, traditional car factories are like a long, slow assembly line. Tesla's unboxed method is completely different. It's parallel. They use these giant presses to stamp out huge single pieces of the car, which gets rid of thousands of parts and just slashes the assembly time. The goal isn't just to build a car, it's to spit out one of these assets every 10 seconds.
And the design itself? It's an exercise in brutal simplification. You get rid of the steering wheel, the pedals, the mirrors. And yeah, that saves money on parts. But more importantly, it means there are way fewer things that can break. This obsession with simplicity goes all the way to energy efficiency. They're targeting almost 6 miles per kilowatt hour. That's about 50% better than most EVs on the road today. And a smaller, more efficient battery is the #1 way to get that upfront cost down.
So all this amazing engineering, this radical new manufacturing, it all boils down to getting one single number right. And it's the most important metric in this entire conversation, the cost per mile.
And there it is, 18 cents per mile. This is the holy grail. This is the number that, if they can actually hit it, could completely rewrite the rules of transportation. So how in the world do you get to 18 cents? It's not magic. It's just math. If you look at the breakdown, depreciation is only 3 cents a mile. Why? Because the vehicle is designed to last for 1,000,000 miles. Energy is less than 2 cents, thanks to that insane efficiency. The rest is a mix of things like maintenance, insurance, and network fees. Every single piece of this has been engineered to crush that cost.
And this is where you really start to see the mind-blowing scale of the disruption. We're not talking about being a little bit cheaper. At 18 cents a mile, a Robotaxi isn't even competing with an Uber or a Lyft at $2.50. It's making their entire business model obsolete with a 90% cost reduction. Heck, it makes owning your own car look ridiculously expensive. But here's the secret weapon, the real magic in this whole equation. It's utilization. Think about it. Your personal car just sits there, parked, 95% of the time. It's a depreciating liability. A Robotaxi, on the other hand, is designed to work 70, maybe 80% of the time. It doesn't sleep. It's always out there, driving, making money. And that's what turns it from a product into a relentless cash-flowing asset.
And what happens when you take that cash flow and reinvest it? Well, this is where things get kind of crazy. Let's say you start with one vehicle. The money from that first one helps you buy the second one. Then the money from those two buys the third one even faster. Look at this model. You start with 1, and by the end of year 1, you have 5. By the end of year 2, you have 38. And by the end of year 3, that single initial investment has compounded into a fleet of over 300 vehicles, generating hundreds of thousands of dollars a month. That is the insane power of compounding.
Okay, so that's the dream. It sounds amazing, right? But now, it's time for a cold, hard dose of reality. Because that beautiful promise of software-like profits is about to slam head-on into the messy, expensive, and unforgiving world of physical hardware.
Right now, the market looks at this whole thing and sees a software company. They're pricing this in with the kind of profit margins you get from code, where it costs almost nothing to sell another copy.
But here's the problem. A Robotaxi network isn't just software. It's a massive fleet of physical things, out in the real world, getting dirty and breaking down. And that comes with a completely different set of risks.
You want to see what I mean? Let's just look at the good old rental car business.
Take Avis. This is a company that has to spend $12 billion a year just to maintain its fleet. They're drowning in almost $30 billion of debt. And over the last 5 years, they actually had negative free cash flow, which led to negative shareholder equity. Yikes. That's the brutal financial reality of managing a giant fleet of cars.
And then you have what I call the unmentionables, all the annoying costs people don't talk about. Heavy EVs with all that torque just chew through tires. A robotaxi driving all day every day might need 4 new sets of tires a year. That could be up to $12,000 just on tires. And who cleans it when someone makes a mess? You need a whole professional cleaning crew system. And who's liable in an accident if there's no driver? It all falls back on the platform and the owner. These hardware costs can eat away at those perfect unit economics one by one.
But okay, let's just pretend you solve all the hardware problems. Even then, this entire multi-trillion-dollar idea is stuck behind one final massive gatekeeper. The software has to be pretty much perfect.
You see, getting to full unsupervised self-driving isn't a flip of a switch. It's a long process. And while the current versions are good enough for some limited testing in a few cities, Tesla has been really clear. A big, global rollout cannot happen until version 15 is ready and validated. Everything, and I mean everything, hangs on FSD 15.
And here is the really crucial and kind of tough part. It's now confirmed that Hardware 3, that's the computer inside millions of Teslas that are already on the road today, it's just not powerful enough to run that future unsupervised system. So that means millions of people who bought the full self-driving package over the years, dreaming their car would become a money-making robotaxi, well, they can't. Not without a major and probably very expensive hardware upgrade.
So we've got the utopian dream on one side and the brutal reality on the other. What do you get when you smash those two things together? You get something completely new, a new class of investment asset with a totally unique mix of risk and reward.
So you have to stop thinking about a cybercab like you'd think about a Honda Civic. You have to compare it to other things that make you money, like stocks or bonds. The S&P 500 might get you 10% a year. Private credit, maybe 12%. A cybercab fleet, if the math works, could potentially yield 40 to 100% a year. But what's the catch? The risk isn't the stock market going up or down. It's a binary bet on whether they can clear that final software hurdle.
And this new type of asset also creates a completely new job for humans. It's kind of like what's happening in finance. AI can analyze all the data, but the human advisor's value is shifting to strategy, to coaching. It's the same idea here. In a world of autonomous fleets, your job isn't to drive the car, it's to be the fleet commander. The most valuable skill is figuring out where to deploy your cars for the most profit, how to manage maintenance across a whole city. The human role goes from doing the work to being the strategist in charge.
And all of this brings us to the final and maybe the biggest consequence of all. This goes way beyond one company's stock price. This is about the future of work itself.
That huge gap we saw earlier between the $2.50 a mile for a human driver and the 18 cents for a robot, that's not just a profit margin. That's the sound of our society fundamentally repricing the value of a human doing a task. That value is being surgically pulled out of human labor and transferred to the owners of the autonomous capital that replaces it.
Some analysts, when they talk about this, they don't mince words. They say that gap represents what could be the single largest transfer of wealth from labor to capital in human history.
You know, the spreadsheets look beautiful, the compounding curves are hypnotic, they go straight up, but at the end of the day, the prize will go to whoever can actually master the brutal, messy reality of both the atoms, the physical hardware, and the bits, the perfect software, to make this incredible vision a real, working, global network.